kind of picking back a little bit more, and this is probably one of my favorite topics, is what are the factors that affect your interest rates, right? When you're qualifying for a mortgage, I usually like to break it down in 3 different categories of factors that affect your interest rate. And I have them broken down. So the first factor is based off of the consumer themselves, right? The client themselves. The second factor is essentially outside market factors you can't control, which is basically what we're dealing with right now with inflation, the Fed looking to slow pumping money into it, and then you have the house itself. So from the consumer standpoint, the first part, you have your down payment or your loan to value. The more that the client puts down, the more competitive his interest rate is going to be without any risks, because he's financing less and he's showing to the bank a commitment of the collateral that they're giving being less than what somebody financing at a max loan to value is. Okay. Credit score is obviously probably one of the strongest factors that affect a lot of consumers from being able to get closer to that benchmark rate, as opposed to being hit with what's called credit score risk factors, right? It's based off of a FICO score. FICO scores are based off of 850, right? 850. So if the consumer has a 700 credit score, not the worst, but he's 150 points short of that 850 score, he will likely be risked, as opposed to another client who has an 800 plus credit score. Debt to income is a big one, and that's just simply put where basically the amount of money that you essentially have against you in regards to your income. What it is it's the mortgage payment plus your revolving minimum balances a month get added together. It gets divided by your gross monthly income, and that gives you what's called your debt to income percentage, or your DTI percentage. Okay.
Question right there, because that's where, now this is where I love not being a realtor or a lender, and everybody else is here. I was a buyer. So when we were calculating the debt to income ratio for me initially, I'm like, well, doesn't my car insurance go in that calculation? Like, what about like PSENG? Like, I pay all of this. And you were like, no. So I feel like it's important for realtors to know, like, what is calculated as part of the debt? Is it just
so great question,
right? Revolving credit, is that the key word?
So one of the main things, it's the credit that reports on your credit report. That makes sense. So your car note, your installment debt, your revolving minimum credit card debt. Now, what also another thing that you put that's not included on your credit report is actual debt that you're responsible for, such as alimony, child support, and things along that nature. IRS debt is a big one, right? Where you want to make sure if you have IRS debt, it needs to be paid off, or you need to be on a payment plan showing consistency of payments being made. Some banks have different restrictions. Usually it's 3 payments consistently. That has to get factored into your debt to income, and then see if you still qualify. Wow. So a lot of different stuff, but like cell phone bill, utility bill, things along that nature, and especially cell phones being so expensive nowadays, you would think eventually they're going to get reported to your credit, but those do not. Child support, alimony, tax debt, things along that nature, plus obviously the minimum revolving debt is what gets calculated, and it varies per loan type too. So an FHA loan is a Federal Housing Administration loan. It is not a first-time home buyer's loan. That's what a lot of people usually say. An FHA loan is not a first-time home buyer's loan. No. First-time home buyers tend to take advantage of them because you can put only 3.5% down, which you're going to be surprised. There's going to be a lot of changes right now that's happening with the Department of Housing and Urban Development, because it's sponsored through the government. So another misconception, the government does not lend on an FHA loan. The bank gives the money for an FHA loan. The bank is insured through the Department of Housing and Urban Development. Okay, so that's another thing that people usually confuse. An FHA loan does not come from the government. It's insured by the Department of Housing and Urban Development. And then obviously a conventional loan is directly coming from the bank. And then you have VA, USDA, and other programs out there. But an FHA loan allows you from a debt to income perspective, depending on multiple factors, but usually you can borrow up to 56.9% of whatever income you make versus your debt. Conventional, in some instances, allows you to go as high as 45% or 49%, depending on if you have contributing factors. So easiest way, realtors, if you guys want to kind of obviously trust the mortgage expert to do it for you, but quick thing that I usually tell people is it's essentially 50% of your income cannot exceed for your debt. So if you make $10,000, quick synopsis, you cannot be paying out more than $5,000 a month in debt being reported against you, revolving, plus your monthly mortgage payment. So if you're making $10,000 a month, 50% of that is $5,000. Your mortgage payment is $3,000, which again, we're going to dive into in 2 seconds what composes a mortgage payment, which is essentially your principal, your interest, your taxes, and insurance. After the $5,000 minus the $3,000, you're left with $2,000. You cannot have more than $2,000 of minimum payments. So minimum payments for your credit cards, minimum payments for your student loans is a big one too, and minimum payments also for your car notes cannot exceed $2,000 in that example. The other factors we already went over in detail. I won't dive into it too much, but mortgage-backed security, treasury yield, unemployment, and new construction, that's really what we're going through right now. Cannot control it. It's been pent up for a little while. We've been kind of, say this as nicely as possible, babied for the last 2 years, right, with super, super low interest rates, and we're going to see them start trajecting higher. And then the home. So believe it or not, when you have different factors for your home, there's different interest rates that are available. If you're purchasing a condo or a multifamily home, you're likely going to have a risk factor against a consumer who's buying a single family home. So that's a big one, Jasmine. So if somebody's buying a condo, there usually is about, from what I normally see, about a 0.75% risk factor. And it really depends by the lender, but there's always going to be a risk factor if they're buying a condo or a multifamily home because there's a higher chance of default on those specific type of homes than a single family home.
Wow. Okay.
Yep.
There's a question in the chat. If a buyer already has an FHA mortgage and buying another property, can they qualify for another FHA loan?
No, only if it's within a certain distance. So it really depends. Usually, if I'm not mistaken, it's a 50-mile difference is where they can. And the main reason why is because FHA must be owner occupied. You must be living in the home when you're getting a new FHA loan. So you can't get one FHA loan for 3.5% down, and then 6 months later, the house down the street be able to get an FHA loan. Okay, so usually you would have to get an FHA loan. And then if you're looking to buy another home, again, not coaching anybody, you must follow guidelines, but FHA requires you to live in the home immediately within 60 days. So you have to move in the house within 2 months. You have to live in the house for a minimum of a year. Okay. Conventional, same thing. But also conventional allows you to purchase what's called a non-owner occupied home. If it's a single family for a conventional loan and you're looking to essentially get an investment property, you could put 15% down. And if it's a multifamily, non-owner occupied, you have to put 25% down.
Geez, did that go up? 25?
No, it's always been multifamily, non-owner occupied is 25% down. Single family, non-owner occupied is 15% down. That's usually general guidelines. I can confidently tell you that's our guidelines with PRMG. Maybe some other lenders have different overlays, but usually Fannie and Freddie require that. And that actually piggybacks into the next one, occupancy. So you have owner occupancy, where you live in the home, which means that you're not going to have a risk factor. If you're getting a non-owner occupied home, you are going to be risked because, again, there's a high level of chance where you can be where the home cannot be rented out. We saw that. We saw that extensively with COVID. So many people now, the courts are going to be backed up for years because of people trying to get evicted, right? And because there's a high risk of you not being able to get a return, right, or get rented, you're going to likely get risk because of that. There was a question also within the forms with Robert Murillo, and I couldn't add it to the slide because it came in earlier today. But Robert, I don't know if is Robert on the call?
Yeah, he's there.
Rob, if I had the answer to this question, it's like I told Jasmine, I would not be here telling you guys that. I would have been investing and making millions and millions of dollars if I could figure out the accurate formula. But if I can definitely tell you this, there's usually a 30% is what you want to look at for ROI, for your return on your investment, right? A lot of different factors that you look into. There's also, if you're looking to do like a fix and flip, usually they say don't pay more than 70%, right, of the fix and flip. There's no real general rule. It all depends on factoring in your taxes and escrows can also go up too. So when your taxes and escrows going up, I can't tell you how many times, Jasmine, I guarantee you next year, you're going to call me. Hopefully I'm wrong, actually. And you're going to be like, hey, I'm getting this piece of paper that is telling me that I have to pay an extra $300. What is that for? I thought my payments were going to stay the same. Your payments do stay the same from principal and interest from what you borrowed from a bank to your return. That can never change. Fortunately, can go up or can go down, right? Multiple factors are involved depending on if you make repairs and things like that. So you want to make sure that when you're going to be doing that, you have at least an understanding of your payments might go up. So Albert, I hope that kind of answers your question, but there's definitely no, and I love how you used it, foolproof age-tested formula. There's no foolproof age-tested formula. At least I should say this, not that I personally know, and I'll leave it at that. There may be some very successful investors out there that can at least tell us, what to look for and what not to look for. But from a mortgage standpoint and a personal investing standpoint, I have a multifamily home in Bergen. I always look at mortgage payments covered. Keep a little bit of money, especially when you file your taxes for your Schedule E taxes. You want to make sure that you're taking not a loss, especially if you're looking to buy another home. That comes into play as well. But I could tell you personally, I don't know of any foolproof age-tested formula that works, right? And if you find it, please let me know, because I would want to know that.